What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Friday. I hope you guys are doing well. On this show, I cover Bitcoin and macro, very broad uh, topics here, talking stocks, talking commodities, of course, Bitcoin, some technical stuff on Bitcoin as well. Today, what I have lined up is we're going to talk about the jobs report that came out this morning. Just read through partially through a quick article, and then we're going to watch a video that someone sent me on a Twitter DM a couple months back, and they wanted to see if I agreed with this video because my vision or macro thesis is very different than most Bitcoiners, and I would go 90% with this guy. Okay, but then I'm told that he's an MMTer, which I am not. I'm an Austrian guy, or at least that's my roots from the Austrian school. So we're going to watch through this video together, and I will react to it. So let's start first by sharing the screen. Oh man, maybe I don't have my website pulled up. One second. There we go. Hey, how come you guys are seeing that? All right, share this. Bitcoin and markets.com. This is where you go to get all of my content. You can see the first one here is the February price forecast competition. Every month with the paid members on the website, we do a fun, friendly competition where we guess the price at the end of the month. And last month's winner was AJ. Congratulations. He won $20 in sats over the Lightning Network. So if you guys want to become a member, support me for $5 a month, you can enter this competition and have a chance at winning $20 back. That pays for 4 months of the membership. So, okay, so that's bitcoinandmarkets.com. And you guys, I'm going to make you bigger because I'm not sure if you're going to be able to see this. Oh, crap. Sorry, guys. I am all over the place. I'm trying to go. I'm going out on Telegram and Rumble and YouTube and sharing my screen in different places, and it's hard to get it all straight. Let me just pick the chart, and we'll go right into the charts. There we go. Yeah, now I'm seeing what the problem is here, Telegram. You guys can't see this. I wonder why that is. Stand by. See, now you can see it when I'm actually live in here. Man, that's distracting. So I am going to just, unfortunately, I'm going to have to stop sharing the screen on Telegram until I can figure that out. So, sorry, guys. When we get to the video, I will share the screen for the video. That way you can hear the audio of the video as well. But all right, so we are on the chart. And we're struggling with this 50-day moving average. We closed above it twice, then below it, now above it. And it looks like we're going to close above it again. So we'll see by the end of the day. The the inflows to the ETFs slowed yesterday down to, I think it was like $38 million net inflows. And some people were saying, they slow down towards the end of the week. Of course, my argument still is this T+1 or T+2. We don't know which days these flows are going. If they cobble together, a day and a half and put that out, and then the next one is half a day or whatever. But it looks to be getting a little bit more steady. And so I think we will be able to get more information out of that in coming weeks. But that is the Bitcoin chart. Let's go into the big movers today. The big mover today was US 10-year. Came all the way up here to the 50-day moving average. That's what this blue line is. And has pulled back a little bit since then, but we will see where that closes. I do expect it to continue to go lower through the first quarter because the first quarter, we're already starting to have banking crises. And people are going to flee into safe and liquid assets, which is a big part of this video we're going to watch here in a second as well. But okay, that is the 10-year. Let's take a look at stocks. They just rallied like crazy here. This is pretty awesome. Let's take these off. Um, so people, of course, on this big red day back on Wednesday, everyone's screaming, the crash is here. The crash is here. And it turns right around. So I'm pretty happy with this arrow that's going up through the first quarter into the middle of the year and then down. And you'll see why especially when you watch this video, he explains almost the same type of stuff I talk about, but he is coming from a different school of thought. So towards the end of our analyses, we differ, but throughout the entire way, we agree. And I've been saying for a long time, stocks are going to go up, bond yields are going to go down. That means bond prices are going to go up. Safe havens are going to go up, like gold and Bitcoin. And that's exactly what we've been seeing. So, all right. And last but not least, let's take a look at the dollar. Dollar had a really good day, pushing up against this horizontal resistance. We'll see if it can break this in coming days. There is no real threat right now of the dollar becoming a dollar wrecking ball again, at least not for a long period of time, because you can see this was the dollar wrecking ball throughout 2022, and now we're just range bound. I've talked about this previously. I thought we were going to be range bound at a higher range, but we are looking like we're range bound right now between 100 and about 107, and that could go on for years. So yeah, that's the thing I'm watching, and so we'll end it back on Bitcoin. All right, let's get into this next post. And this is from Zero Hedge. The headline is Inside the Most Ridiculous Jobs Report in Recent History. Jobs report came out. There was a ton of stuff going on. I shared an image from Jeff Schneider. Actually, let me just look that up. Sorry about this. 1 second. This was a very good comparison. Share this tab, open this up. So here we go. Let me make sure all my levels are correct. Everything's looking good. All right. So this is the CES Establishment Survey. So there's different jobs reports, but this is the CES Establishment Survey. And inside that survey, they have different things. They measure payrolls, and you can see this, how Jeff Schneider is pointing out, look at the payrolls going up here. Healthy. This is a healthy amount of jobs 2 months in a row. Or if you go into the weekly hours for all employees, they're diving down to COVID levels. I wish you would zoom back out to the Great Financial Crisis, because it's probably lower than the Great Financial Crisis. All the way down here at 34.1, it looks like 34.1 hours a week. So these two metrics from within the same survey do not agree. And we were talking about it a little bit on Telegram. It seems as if people are losing full-time jobs and they're getting 2 part-time jobs that don't even add up to 40 hours. That's the only thing I can think of that would explain this. That, or there is just a complete methodological problem with how they are collecting this data. Or, I mean, I try not to be a conspiracy theorist, but that would also fit here, where they mess with the payrolls number, but they are too dumb to mess with the weekly hours. So anyway, that is interesting. Let's get back to this article from Zero Hedge. On the surface, it was a blockbuster jobs report, certainly one which nobody expected. Starting at the top, the BLS reported that in January, the U.S. unexpectedly added 353,000 jobs, the most since January of 2023. My Lord, stand by. Oh boy, neighbor kids ringing the doorbell in the middle of my live stream. I need to get like a go live light out there, say, do not ring the damn doorbell. Okay, let's get back into the story. Okay, double the consensus forecast of 185,000 and more than the highest Wall Street estimate, 300,000. Okay, in fact, this was a 4 sigma beat to estimate, unheard of in the past year. So you can see this dot right here. That is how far out from the consensus that this beat was. That tells you that most likely it's going to be revised lower. The headline data was stellar across the board, starting with the unemployment rate, which once again failed to rise, denying expectations from Sam's rule that the recession may have started already, all the way to average hourly earnings, which unexpectedly spiked from 4.1% pre-revision to 4.5%, the highest since last September, and a slap in the face of the Fed's disinflation narrative. So hours worked is going down, wages are going up, and jobs are going up. I mean, there is some major problems going on in this report, but it feels like the hourly hours worked is the thing to consider. But yeah, this is also interesting, the hourly earnings. Or it would be if one didn't think of checking how the average rose. Well, it turns out that since average hourly earnings is a fraction, it did not rise due to a jump in actual wages, but since it is the earnings over a period of time, rose because the BLS decided to sharply slash the number of estimated hours that everyone was working. I get it. Okay. That makes sense. So since hours dropped, wages rose just as a mathematical artifact of the way they do this. Okay, that makes sense. Which may not sound like a lot unless one realizes that the last time the work week was this low was when the economy was shut down during COVID. Excluding the COVID lockdowns, one would have to go back to 2010 to find a work week that was this anemic. Okay, so 2010, you can see on the chart here, that was even much lower. But by this point, we were already halfway through the recession. So, very interesting. And speaking of revisions, we had a lot of those. In January, the BLS conducted its annual benchmarking and update of seasonal adjustment factors. Long story short, what was until December a decline in jobs has now been miraculously transformed into gains, as shown in the chart below. So here, let's look at these revisions. So pre-revision is the orange. December. Look at that revision all the way up. Everything got revised a little bit higher, except for this one, February 2022. But it looks like this one here, May. So a few of them, but it looks more like about 75% of them got revised up. All right. For those asking, the revisions were unambiguously designed to give the impression that the labor market is slowing much less than it is. Consider this. Before the revision, the average monthly job gain in 2021 was largely unchanged. And while the average monthly gain in 2022 was revised lower, this is purposefully goal-seeked to make 2023 appear stronger. And indeed, the average monthly increase in 2023 has been revised from 225,000 to 255,000. Okay, so purposefully goal-seeked, that's obviously not provable. I do think it's funny that we have things like the election year right here, and we're having all of these problems with the data. And most of the time, I would say that's a little bit out of the realms of possibility. But when you look at this administration and you look at the lengths at which they will go to thwart the competition, messing with the jobs number on a scale of like corruption, messing with the jobs number is less than filing 91 felony charges against your leading opponent. So this is in the realm of possibility that that's happening. Okay, so that is all I have for the jobs numbers. Let's get into this video, and I'm going to share screen here for you guys now. All right, so this is from Ratik Goyal. Like I said, I think he's an MMTer, but the first part of this is right up my alley. That sounds bad, but he looks at it as, hey, they're doing this wrong because they're not looking at it from an MMT lens. So he's explaining how it is, and then he's going to, by the end, which we're not even going to watch the very end, he gives his MMT prescription. So we're going to watch the part where he's talking about the system as it is, and it's pretty interesting. So let's get into it.
This presentation is called The Fed Does Not Exist, and it's a companion or introduction to the book with the same name. And the goal is to really deeply understand what all actually is in the Fed's toolkit and what isn't, and how the Fed is or isn't able to actually influence economic conditions. So hopefully by the end, we can recognize that there doesn't actually exist an independent entity that can manage economic conditions like we think the Fed is able to.
Okay, now I want you just to get that claim. There is not an entity. The entity of the Fed does not exist. Of course, later on, he gives prescriptions for how the Fed should behave. So which is it? Does it exist, or is it just doing something impotent? I think obviously the Fed does not exist is kind of a little bit of marketing, but yeah, let's keep going.
So at a high level, there's sort of two pieces. First, that the Fed doesn't get a free lunch, just like you or I don't get a free lunch. And what I mean by that is that the Fed doesn't have the ability to magically just add returns to the system or destroy risk from the system. And the reason for this is that the interest rate that the Fed set isn't what we pay out of the system into some sort of black box. It's the rate that we're paying each other. So when you reduce that rate with the intent of stimulating the economy, it reduces the cost of capital for some players. But by reducing the income from interest for another player, it raises their cost of capital because income and profits are what determine the cost of capital.
That's a very good point. And I think he explained that pretty well. So as interest rates go down, it's not stimulus because it's actually taking away income from certain people. There is no free lunch in the current system. Very, very well explained.
And then the second point is that based on this idea, the Fed cannot destroy risk. It can only shift who is holding the burden of the risk, whether that's between players or through time. And if we take the kind of Markowitz idea that the only free lunch out there is diversification, then the only way that the Fed can give the system a free lunch is by redistributing that risk in a way that diversifies that risk. And we'll get into what this means. So on the first piece of that, which is the interest rates part.
Some of this, comes from a more technical angle than how I approach these things. But that's one thing that made it very interesting, that people can come from two different angles and get the same sort of understanding of the system. I would put myself and Jeff Schneider in the same boat. He's coming from a monetarist point of view, like in the school of Milton Friedman, and elasticity is the most important thing. So he is coming from that school, and I'm coming more from an Austrian / Bitcoin school. But we have come to a very similar understanding. Now, what is our vision or prescription of future? That differs because I see us going back to hard money and Bitcoin standard. And he sees us somehow fixing the elasticity problem, which is not clear that it can be fixed. And now this guy here, he's coming from a little bit of a wonky perspective, not a global qualitative perspective, but from a quantitative perspective. So I think that that's very interesting.
Interest rates are like any price. So if you lower the price of something, then the person who's selling that thing will stand to make less. And that's because one person's spending is another person's income. And spending on interest is no different. So if everyone is borrowing at low rates, then everyone is also lending at low rates, which means that everyone is earning low rates. And as income falls, spending falls. And then the second piece was diversification. And here we introduced the idea of...
Well, that's one thing I've been saying, right? When rates go down, money's tight. Now, why is that the case? Well, he's explaining it because income, interest is somebody's income. And if interest rates are going down, it means your income is going down. I explain it as the economy is not expanding. The demand for new loans goes down because people are tightening their belt and they don't want to take out new debt. They don't want to expand their business. So they go into safe and liquid assets. So the demand is shifting towards safe and liquid away from riskier uses of that money. And he also points this out, but I just want to set that up a little bit here.
Of complements and substitutes. So this is kind of like an Econ 101 way to describe how two things can interact. So two things can either be complements, which are items that make sense to hold together, like a printer and ink, or substitutes, which are items that make sense to hold instead of each other, like two types of printers. So with complements, as the price of one item goes down, the attractiveness of that two-item pair goes up, which causes the price of the second item to go up. And then with substitutes, if the price of one item goes up, the attractiveness of the other substitute goes up, which causes the price of that item to go up. So this is sort of like a way to visualize using a seesaw how substitutes and complements can interact with each other. So if we have an item A, then as the price of that item goes up, item A is on the left side, as the price of that item goes up, the price of substitutes for that item go up, but the price of complements to item A go down. And the seesaw will be useful shortly. So here we have an example that I think kind of demonstrates this. So the thing to recognize here is that if an item's complement is expensive, then I can hold fewer of that item because that means that the pair itself is now more expensive. So in this example, let's say that I have $100 and I have two items, phones and phone cases, which are perfect complements, which means that I need one in order to have the other. I need them together. And let's say they each cost $1. Then the optimal allocation would obviously be to split the $100 equally, 50-50. But now let's say that cases cost $3. So the phone case pair now costs $4. Then the new optimal allocation would be to only have 25 of these pairs because we have to dedicate $75 to the cases. And on the other hand, if we kind of reduce the total price of that phone case pair, so instead of $1 each, now let's say cases cost 50 cents, then I can buy 66 phones and 66 cases because the cost of the two-item phone case pair has fallen. So we can actually apply this logic to assets too, which we can also treat as either complements or substitutes. So as an example of this, an example of complements would be like ExxonMobil stock and a treasury bond. And the reason for this is that the properties of these two assets are so different that they help the portfolio of these two assets cover a larger range of possibilities. Whereas if I had a portfolio of just Exxon stock and Chevron stock, which are closer substitutes, then I'm not really covering as large of a range of possibilities in my portfolio. So we can kind of take.
Okay, let's skip forward here a little bit. All right.
So how do we determine if two kind of actual real world assets are substitutes or complements? So the answer is that it depends on the exposures of each asset. And so the three main drivers of return are growth, inflation, and liquidity. So typically when we look at the risk curve, which is this chart on the left, it has all of its assets with their expected returns and risks. And it makes sense that assets with higher risk should also pay a higher return. But we can actually break up these assets into their respective drivers where they can actually sit on different spots. So quickly on liquidity, by liquidity, I mean the supply of all marketable assets that have an observable price and can be sold for cash, not just all cash or cash-like assets, such that when liquidity is rising, that means that the supply of all marketable assets is rising, in which case you don't want to be already holding those assets because now those assets are competing with a larger set of assets. And then when liquidity is falling, the supply of all marketable assets is falling, in which case if you're already holding on to some of those remaining assets, then you're in good shape.
Okay, so that's what I wanted to get out of this little section was his liquidity definition. And what I've been talking about, is people who look at like M2 or the Fed balance sheet, and they think that those things are rising, that liquidity is rising. But the reason those things are rising is because there is lower liquidity out there that needs that to supplement it. So he does a good job of saying that the total value of marketable assets is shrinking. And so people go into the safest assets at that point. As it's shrinking, liquidity is going down. So it's almost a tautology. If rates are going down, that means the total supply of marketable assets is decreasing. If the total supply of marketable assets is increasing, rates will rise. So same thing, kind of just different way to say it. Let's see if there's anything else here. I wanted to, yeah.
So this notion of liquidity kind of goes against the typical idea of the Fed adds liquidity by printing money, which has all sorts of problems with it. And I describe this more in the book. But the big point here is that it doesn't make any sense to call liquidity just the supply of cash and cash-like assets, because when that supply is rising, it's actually an indicator that things are getting worse. But you would obviously want to think that rising liquidity is a good thing. And I explained why rising, Fed liquidity or rising cash liquidity is an undesirable thing for the economy later on in this presentation. So now if we take these kind of three dimensions and put them in sort of a crude XYZ graph, we can see that every asset sits somewhere in the space, but some assets are actually further away from each other than others. So we take bonds, for example, government bonds. Bonds are sort of like the ultimate falling inflation, falling growth, falling liquidity asset, because when those things are falling, you want to be holding an asset that pays you kind of a fixed cash flow no matter what. But bank loans, on the other hand, are almost as far away from bonds in terms of their return profile as possible, because they have a completely different set of exposures. And so this actually makes bonds and bank loans good complements, because if you hold a portfolio with both of these, your portfolio is now covering a larger range of possibilities. Whereas let's say if you had a portfolio of government bonds and corporate bonds, that portfolio is more kind of holding two substitutes, because those two assets cover more of a similar range of possibilities.
So see, I told you he came a little bit from a wonky angle. That was a really cool representation of that. Okay, so here he gets into the seesaw more.
So going back to the phones and cases example, if we kind of plop these two items on our seesaw, because they're complements, they sit on opposite sides of the seesaw. So if you wanted to raise the price of phones, which is on the right side, we could only change the price of cases, which is on the left side. What you should do is lower the price of cases, which will raise the attractiveness of the phone case pair, which will end up raising the price of phones. Now, if we apply this to assets, we can similarly put bonds and loans on opposite sides of the seesaw because of their complementarity, which means that if we wanted to raise the value of loans on the right side, but we could only change the price of bonds on the left side, we would actually have to reduce the price of bonds, which would raise the attractiveness of each bond bank loan pair, which would raise.
So in my kind of parlance, what his loans over here, these bank loans, that's for people that want to expand their business. People that want to maybe start a new business, buy another truck for their business or something. And so those are these bank loans, and they're on the opposite end of the scale of bonds because they are the most risky thing out there. Stocks will actually fall a little bit on the left side of the fulcrum here because they are large, publicly traded, regulated entities with lots of assets, right? And so especially the largest ones. And he has a comment here in a second. He calls it, there's a lot of bonds in those stocks. So those big companies, they have a portfolio as well, and they have maybe some bonds and stuff like that. So they are more on this part of the seesaw, where the bank loans for the riskiest activities are completely opposite from the bonds, which is a loan to the government, but this is a loan to the riskiest type of economic activity.
Raise the price of loans in the same kind of logic. So this is where it actually starts to get interesting, in my opinion, because if we take the idea that price and yield for any asset are inverse to each other, then if we wanted to reduce the yield or the interest rate on a bank loan, meaning move the right side down in this case, then the way to do that would actually be to raise the interest rate or the yield on a bond. And so this sounds counterintuitive, but
so if you want to lower the cost of loans, which would be the interest rate that the people taking out the loans has to pay. If you want to lower the cost of loans in the economy to make business boom and make business expand, on the seesaw, what you would do is you would raise the yield of government bonds. The exact opposite of what the Fed thinks. They think they're going to lower the cost of lower the yield of treasuries, and that is actually going to lower the cost for these loans over here on the other side of the seesaw. But in reality, it makes them more expensive.
We go back to the first principle we talked about, which is that when the Fed moves rates, it has to create a winner and a loser. Then I think this starts to make more sense, because the Fed has to take return or risk from someone and give it to somebody else, because these rates are just what we're paying each other. They're not what we're paying out of the system. So another way to think of this is sort of by like process of elimination. So it intuitively makes sense that if the Fed reduces free rate, which is the rate on bonds, it should benefit all bond substitutes to some degree. So for example, like it should benefit the debt that's issued by Apple or Apple stock even. But if we know that the Fed has to take from someone when it lowers rates, and we know that it's impossible to observe the prices of the riskiest activity, of the illiquid activity, and we know that it's, when the Fed lowers rates, it's raising the price of all assets that we can observe the prices of, which is kind of all the bond substitutes. then the only possible explanation is that it's actually taking value away from the activity that we can't see the prices of and bringing it towards the bond and bond substitute activity, which in turn means that lowering the rate on risk-free assets actually increases the required return or cost of capital on risky assets.
So the stuff we can't see, the economic activity that we can't see, that is mom and pop taking out a loan for their business. And that loan is an asset for the bank, but it's not very liquid. It's quite illiquid, actually. So those are the types of prices that we don't see. That's what he's talking about. Okay, let's continue to another section. I want to go to 1443.
So going back to our seesaw of substitutes and complements, we can actually put all these asset classes on that seesaw in some form. And so I've sort of grouped them into three categories. So we have safe assets, which are government bonds, which are liquid and they don't have any credit risk. And then we have risk assets, which have credit risk, but they're still liquid. They still have an observable price and they can still be sold in the market for cash. And then we have risky assets, which is bank loans, which not only have credit risk, but they also don't have the ability to be bought or sold easily in public markets. So from this perspective, it makes sense that the risk-free rate is an input to the valuation of risk assets, where when bond yields go up, the yield on other risk assets go up because these assets are some degree of substitutes. And this is the
Okay, so one thing that I would disagree here is that, of course, it's not crypto, it's Bitcoin, but I would put Bitcoin further down here. It doesn't necessarily have a yield, where these government bonds, the safe assets in this case, they have a yield. Bitcoin doesn't. However, since Bitcoin is a fixed supply, it has a likely guaranteed appreciation. So that's not a yield, but that is a guaranteed appreciation in the purchasing power of your Bitcoin. Unlike gold, okay, gold does not have that because you can dig up more gold. And the more expensive it gets, the more gold they will take out of the ground. So gold does belong here with these blue chip stocks and corporate debt here. But Bitcoin needs to be further along by bonds. I think it is the promise of fixed supply and appreciation, constant appreciation. And it doesn't have to be a lot. Like once we have hyper Bitcoinization, we're going to have Bitcoin only appreciating maybe 2-3% a year or something like that. But that is something, and that is effectively a yield, right? So that's what I would add to this.
idea of there are bonds in the stocks. But the
There
interesting
you
thing
said it.
here is that when the risk-free rate goes up, the risky rate actually goes down. The required return on risky assets goes down, which means that there's short bonds in risky assets for the reasons that we just discussed. And so I'm not obviously saying that the risk yield falls under the risk-free yield, but rather just that the yields of these two asset types move in opposite directions, and the seesaw is a good way to kind of visualize that.
I mean, that makes sense. So let's say you have a diversified portfolio and your safest assets are paying you 5%. Well, now your risky assets, they don't have to be as big a winners. Okay, they don't have to behave as much, and there's less risk to your overall portfolio because your safest assets are giving you 5%. But if your safest assets are giving you 1%, I mean, these have to be very, very likely to succeed, or else you're not going to get into the risky. So it pushes people down. You can also think gravity is pulling people down this seesaw. So if the seesaw tips the other way, right, then people will be pulled down to gravity towards the risky assets, or maybe capital will be pulled down towards the risky assets. But in this version, there's a constant pressure towards safe assets. And what do I always say? I always say that there is a deflationary pressure, and the deflationary pressure will win. So this, if it's tilted to the left, that's a deflationary pressure. If it's tilted to the right, then it's an inflationary pressure. All right, let's continue.
And we even see this with some of the stocks that you can kind of consider more bond complement than bond substitute, meaning stocks that are closer to the risky asset side rather than the risk asset side. So in the 2010s, as bond yield kind of experienced this secular decline, stocks that had some degree of substitutability with bonds. So you can think of longer duration stocks like tech stocks, or stocks with very stable cash flows like kind of consumer staple stocks. these companies, had very strong returns because there was a lot of bond in those stocks. But the stocks that were very risky, for example, like in emerging market, like commodity sensitive stock, those kinds of stocks had very poor returns or even negative returns throughout the 2010s because they arguably had short bonds in them as well, because their return profiles were actually complementary to bonds rather than substitutes. And in this period, the price of bond was going up, so the price of bond complements would go down. So if we think about it, if bonds are a falling nominal growth asset and stocks are presumably a rising nominal growth asset, it doesn't make any sense that higher prices of a falling nominal growth asset, i.e. bonds, should imply a higher price on a rising nominal growth asset like stocks, unless liquidity is falling, which would move all of these assets together in the same direction. So this seesaw kind of explains what we see with asset prices in high inflation periods as well. So in like the 1970s, as an example, all liquid assets, so stocks, bonds, corporate bonds, they all had very poor returns. And the reason for that is that the supply of risky assets, meaning bank loans, was increasing so dramatically because nominal growth expectations were so strong that it seemed silly to buy assets in the financial economy when the real economy looked so attractive. And so that's why the 1970s not only had higher nominal growth than any other decade, but it also had higher real growth than any other decade since like the 1950s, because not only was the rate of production of new assets so robust, but the types of assets that were being produced skewed towards the kind of high risk, high productivity, risky assets like bank loans, rather than more safe and liquid assets like safe and risk assets.
That fact should really be hard to explain for the inflationistas, where inflation is theft. Okay, I do think in a certain world, in a certain way to look at that, yeah, inflation is theft. But if we have a little bit higher inflation, we're going to have a little bit higher growth. That includes you. That includes your business, your salary. So I think that fact of the 70s was high nominal growth, of course, because inflation, quote unquote inflation, the CPI was very high, but it also had the highest real growth. Now that should be the opposite. If inflation is so taxing on the economy, as the inflationistas want you to believe, then it should have been the lowest real growth or negative. If we had that high of inflation, that high of CPI rises, we should have had negative growth. But we didn't. We had positive growth, the highest decade since World War II. So it's crazy.
And so even though we couldn't directly observe the price of those risky assets, we could see this dynamic playing out in the form of the price of bonds and bond substitute assets starting to fall. And this also reveals the problem that I have with the sort of wealth effect as being used as like the primary determinant for cyclical dynamics, which is that in order for there to be a wealth effect, there must be a shortage of financial assets, which is inflating the remaining supply of assets. And if there's a shortage of assets, then there must be a shortage of money, because money is sort of just the liabilities that match those assets, which means that there cannot be strong nominal growth in an environment of high financial asset prices unless those high asset prices reflect high asset cash flows rather than high asset valuations. But high asset cash flows would also just mean that assets are cheap, they're not expensive. So in that sense, the wealth effect is actually evidence of falling nominal growth expectations.
Okay, what he said there was very important. As you're having asset price inflation, it goes together with low growth. It also goes together with a safe asset shortage and a cash shortage. So remember this here. We're tipped to the left. Gravity is pulling us down and pulling capital down towards safe assets. And there's going to be a shortage because everybody wants them. There's a shortage of cash. There's a shortage of these safest assets because gravity is continually pulling capital this way, and it's pulling capital away from risk assets. Okay, let's go back to right here.
And sort of play with aggregate risk and return. But the Fed itself only has access to one side of that seesaw, and it's effectively treating that side like it's the fulcrum. So I've shown that as like the Fed being this boot that is like stepping on the treasury yield. And so this approach to monetary policy has consistently not worked, which I'll get to shortly, because when you reduce the yield of some assets, you necessarily raise the yield of complementary assets because the burden of diversification gets passed on to those assets. And so when I talk about diversification, I'm talking about at an economy-wide balance sheet level, not that like every player has a diversified portfolio, such that when the economy as a whole is diversified, it means that for every player that is vulnerable, there's another player that's protected. which means that the system as a whole is more resilient, and that makes contagion less likely. And then when risk-free rates are too low, there end up not being that many players that are protected, which then puts the system more at risk.
And you can see also in this, if you're thinking that, gravity is pulling capital to the left. Now, where is the actual economic growth? That's on the right side. That's on the side that's being starved of capital. So this also explains why we see a rise in financialization. And also, if there's a shortage of safe and liquid assets on the left side because all this capital is flowing down into that, that is what gives us things like mortgage-backed securities and CMOs and CLOs, because people are looking for a safe and liquid asset. So it's the shortage of these things due to low interest rates that is pulling this way. All right. Now here he has the boot of the Fed. Remember, the Fed does not exist according to Ratik. But let's continue listening.
So this is sort of a visual presentation of what the Fed either thinks it's doing with monetary policy, or what the Fed needs everybody else to think it's doing, which is that we should treat all assets as like built up on top of this risk-free rate, so that the Fed just moves the risk-free rate around, and that moves all assets around, and the Fed is just able to like hand the system a free lunch and reduce the cost of capital for all assets. But the Fed has never been able to do this, both historically and logically, and we'll get into some of that history shortly. So the core argument of the Fed does not exist, like I just said, is that kind of a real central bank has its hands on the fulcrum of the seesaw, whereas the Fed and also every other central bank has its hands on only one side of the seesaw. So the reason the Fed doesn't exist is because its ability to kind of mechanically shape economic outcomes in the way that it thinks it can, or that we think it can, doesn't actually exist. And here's where we add another wrinkle.
So he used the term I use very often, is mechanically. The Fed cannot mechanically do this. So all they're doing is trying to influence. They're doing PSYOP. They're doing an influence operation on the market because they don't mechanically work.
Which is that if the Fed were to be able to convince everybody that it did have its hands on the fulcrum, then it effectively would have its hands on the fulcrum. It would have that power. But the Fed has actually been able to only credibly convince the system of this from about 1981 to 2013. And we'll get into that history shortly. But a question that I like to come back to is that, if there was no Fed and we had a recession, what would happen to interest rates? And the answer is that interest rates, meaning the risk-free rate, would fall all by itself without the Fed, because there would be a rush into safe and liquid assets, and there would be a rush into cash, which I think begs the question of, is the Fed actually doing anything stimulative when it lowers rates that the market would already be lowering in, recession? And I think the answer is no. In fact, by acting pro-cyclically, the Fed is just further depressing conditions.
Yep.
So now let's kind of work through the mechanics of why the fulcrum is in the middle and not with the Fed. So let's go back to our seesaw. So the core argument here is that, when the Fed reduces the risk-free rate, it reduces the cost of capital for risk-free substitutes, so like risk assets and safe assets, but it actually raises, start with kind of the classic risk curve. The point here is that, when the Fed creates a safe asset shortage by raising the price of safe assets and making them more scarce, the result is that you actually steepen the risk curve, you don't flatten it, because all of that burden of diversification gets passed to you as a risky borrower, because the system has now no real good risk-free hedge. And
okay, so these are neat charts. This first one is kind of in a normal world. Okay, you're going to have an upward sloping risk curve. Cash, bonds, credit, stocks, and bank loans are at the far right. Now, if you kink it and you cause that seesaw to tip to the left, you can still think of gravity here. Gravity is going to pull that capital down into the lower part of this curve. And the bank loans over here, they're the riskiest, the actual economic activity, mom and pop. Remember, in the United States, it's something like, I don't know, somewhere around 80% of people work for employers that have like 50 employees or less. I mean, the small business is very big in the United States. That's these people over here. So if you are kinking the supply or the risk curve like this, then you are starving capital for the place in the economy that's going to grow. Bonds, cash, credit, like these can be financialized, stocks can be financialized, all this can be financially engineered and all this stuff. But the bank loans, the actual economic activity, is the one here on the right. Okay, then what he says over here is that it actually doesn't extend because they are starved of capital. So it just cuts off right there. And so there's no there's no loans over here. That's kind of where the recession would be like, as this slowly declines, as we slowly cut off more and more marginal people, what's going to happen? Well, more money is going to flow this way. It's going to flee into these safe and liquid assets. So you're going to see treasury yields going down. You're going to see stocks going up, and you're going to see the dollar or cash, people fleeing into cash and having cash on the sidelines. Bitcoin, gold, these are down here, remember. So that's what I have been talking about this whole time, or over the last 2 years, is that as we're going into recession, more and more money gets chased down here into the safer part of the curve. And these people are starved of credit. There's no more loans. There's no more economic activity. So, okay, let's keep going.
And because the borrowers that were borrowing those risky markets now have an incentive to move down into the kind of safer markets, which leaves the riskiest borrowers in those risky markets. So here I kind of depicted this as like a kink in the risk curve, where as soon as you get into the territory of bond complements, the cost of borrowing for those players reflects that lack of the diversification free lunch. And then because now these players' borrowing costs are so much higher compared to what they're earning on their assets, a lot of that borrowing actually stops, which means that the remaining borrowing that's still going on is happening at lower interest rates. So a safe asset shortage actually results in a survivorship bias towards borrowers that still have remaining access to credit, which tend to be already the safer borrowers that borrow at lower rates. So the interesting thing here is that what's happening is that everybody who can move down the risk curve to fill the safe asset shortage does so, and then everyone who can't is now shut out of markets for credit. And the result of this,
everyone, or you can say capital that can, moves down. I'll also say this, that, okay, so over on the left chart, you can see that the cash actually has a positive yield. It intersects the y-axis above 0. So that's a positive yield, and then it goes upward sloping from there. That's very interesting, because that means that we have appreciation, or prices are going down, right? This has cash intersecting at the 0 line, and same with this one over here. But in reality, it's not. The reality is cash is intersecting in negative territory. It has negative yield. It costs you money to hold cash in the system. So this is a little bit, that's kind of super in the weeds, but this line should actually be crossing below the x-axis before it hits the y-axis, and cash is a negative carry. Now, this is a situation that we can get with Bitcoin. No credit-based money can get to this curve on the left. Nothing. The only thing is possibly gold, but Bitcoin for sure. Bitcoin is the only money that is going to get us to have this positive intersection of yield through its appreciation, which is effectively yield. Okay, let's keep going.
This is that it looks like the Fed's actions have flattened the risk curve, when what they've actually done is they've shortened the risk curve. So what's actually happened is that when the Fed cuts rates and does QE, it actually produces a liquidity hole that borrowers from the higher up on the risk curve come down to fill. And that liquidity hole then shows up as less access to liquidity, or less access to capital for the borrowers at the top of the risk curve that don't have the ability to come down the risk curve. And so just to kind of hit this point home, when we kind of consider markets where there's no observable price, these markets actually exhibit asymmetric information because the lenders don't know who the lenders are really, which makes them.
Okay, no observable price. Remember, that's the mom and pop loans that really they don't have a price because they're not going to get traded.
Kind of more risk averse and causes them to raise their average required rate from lending in order to protect against those lemons. And that causes these kind of risky fringes of the market to start to fail to clear, which is that liquidity hole that the safe asset shortage produces. Because now the safe assets that are short in supply are no longer available to act as hedges against something going wrong in the risky markets. And that's how you get this kind of shortening of the risk curve where there's less activity overall.
So where he was talking about lemons, I will say that I've kind of talked about that in the past, where you don't know who you can trust, right? So let's say you're in business and you have suppliers and customers, that you know well, but one of your suppliers goes insolvent. Now, who can you trust? Maybe you you can pay me in 60 days instead of 30 days or whatever your agreement is. But are you going to do that, or are you actually going to go the other way? Are you going to say, man, you're having a hard time. You need to pay me in 15 days. I can't wait 30 days. So it starts shortening all of these opportunities for people. And like he said, the access to credit, the viability of that economic activity on the right side of those curves goes away. So this gets chipped down. And the further we gets chipped down, the closer to recession we get. Boom, then we can hit stocks. Really, that's when people wake up, when this chips into the stocks and stocks start falling, right? But that will happen. This is a progression into recession as this gets chipped away and chipped down. Okay, let me check on Telegram. Yep, you're still seeing everything, right? Okay, let's get into this next section. I think it was just a couple seconds.
Contrary to kind of what we would think, the price of risk-free credit and the volume of risky credit are actually positively correlated, such that, you know, when the red line, the price of credit is rising, the volume of risky credit, meaning like bank loans, is actually also rising. And this is what it looks like.
Okay, that's very important. So remember the seesaw, okay? The red is the left side of the seesaw. As it's going up, all right, what does that mean? That means more money can flow to the right side of the seesaw, which is bank lending to the riskiest people. And so this is volume of bank lending, not yield, volume in blue. So as the left side of the seesaw in red goes up, more volume is coming to the right side of the seesaw, which is blue, and it's also going up. And this is a beautiful chart because it shows exactly how correlated this is. It's exactly correlated.
For the Fed to kind of shorten the risk curve rather than flatten it. So, you know, to shorten the risk curve means that, you know, you reduce the overall volume of credit that's being extended. And that's what rate cuts and QE actually do by creating a safe asset shortage. So the key thing here is that it's, you know, kind of easy to dismiss what we see on a chart because, you know, we don't have the counterfactual and we can just claim that monetary policy has like long and variable lags, such that like a decline in credit volume was actually caused by like an increase in interest rates that happened 5 years ago or whatever. But I think that, you know, the mechanics actually fit what we just plainly see on the chart very nicely. So we don't actually have to dismiss the empirical reality.
Okay, this next part, he gets into some history of the Federal Reserve. We're going to skip that. You guys are welcome to go and find this video and watch that. 3246. I just wanted to talk about this slide. Okay. So this is interesting. So, okay, on the left here, supply of assets, roughly 50-50. That teeter-totter is flat. Okay, the seesaw is flat. What the Fed does, or what they claim to do, is they claim to do this one up here. Lower the emphasis or the return on safe assets, and that will push the volume, like squeezing a balloon on one side, the air will go into the risky side. That's what they think, or that's what they claim. In reality, it's this one over here. So if they push down on the safe, it pushes the risky down too. See? So you get lower growth, lower inflation. Now, this one down here is what he's claiming would be better, and that is actually raising the amount of safe and liquid assets. Because if you do that, yields will go up and the teeter-totter will tip to the right, and more capital will flow to the growth sector of the economy, the bank loan sector. All right. Where am I going next? Is 3828. All right.
And this idea, kind of in my view, is the crux of why interest rates experienced a secular decline since Volcker supposedly caused a recession by hiking rates a lot, which he didn't, and I get into that in the book as well. The main thing is that he didn't cause the recession via interest rates, but rather he attached the recession to his rates to create the appearance of rates driving the economy. But prior to that point, the Fed was widely acknowledged by banks and other kind of actors as mostly irrelevant to conditions. And whenever there was a recession, rates would fall, reflecting conditions getting tighter. And then when the economy was picking up, rates would rise, reflecting conditions getting easier. And Volcker himself made this point in 1980, rates went up, which would suggest that your policy's gotten easier. And then when Volcker flipped this interpretation of interest rates in 1982, he flipped it towards one where falling rates now supposedly reflected policy getting easier and tighter, which meant that now effectively we have a Fed that's mechanically acting pro-cyclically rather than counter-cyclically, which means that obviously if everybody believes that lower interest rates are better and that we need lower interest rates to stimulate the economy, then eventually interest rates will obviously fall towards zero because everybody's working together to make that happen. And that's why in this chart I have easing and tightening in quotes after the Volcker era, because a fall in interest rates isn't actually an easing, it's a tightening. Because when the demand for safe and liquid assets is rising, it must mean that the real economy is doing worse and that money is getting less easy to access for risky players or the private sector.
Beautiful, beautiful chart here. Sorry, my dog's barking in the background. Yeah, before Volcker, they had it right. Yields going down was tightening. Yields going up was easing. This is in the era also of Milton Friedman and his influence at the Fed and on economics in general. Then the Volcker myth was born. And we've talked about this before. Like Volcker didn't cause anything. Volcker just influenced the idea that this was happening. And then the myth of Volcker was born. Jeff Schneider has talked about this at length. And after that, if they can lower rates, then it's easing. The exact opposite of what reality is. Remember the interest rate fallacy? This is exactly where it comes from. Somehow, Volcker got people to believe that lowering rates was easing when it's actually the exact opposite. Okay, that is, let's see, where else what are we at? 40, we got 2 more minutes.
Another point here is that because the interpretation of what the Fed is doing and what market prices are showing is constantly changing, trading markets in a way that uses an understanding of the Fed or other central banks that is supposedly universal and timeless is always going to run into problems, because the reality is that the way that the Fed interacts with the system and whether or not the system even cares about the Fed is very unstable and is always changing.
True.
So this view of things obviously is kind of in contrast to the general idea that what caused the secular decline in interest rates over the last 40 years was a bunch of disinflationary forces like globalization and aging demographics and technology. And I have technology in quotes, which I'll explain in a second, where all these things caused disinflation, which then allowed the Fed to keep rates lower. My view is actually that these things don't just come out of nowhere, but they're rather a natural response to the distribution of availability of money for the system. And what I mean by that is that it's actually the secular decline in interest rates produced by the Fed that
Okay, did you hear that? It is actually the secular decline in interest rates caused by the Fed. Well, I thought the Fed does not exist. So which is it? Because see, I'm in the school of thought of this kind of the way this works here. Globalization, demographics, technology, secular disinflation, secular decline in interest rates. But what he doesn't have on here actually is the debt burden and the diminishing marginal returns on debt. I think that is so overlooked by so many people out there, and it is definitely overlooked by the MMT people. But there is a diminishing marginal return on debt, and that is what this causes the secular decline in interest rates. You got to add in another box and stuff like that. But globalization, demographics, and technology, along with global international peace between great powers, no global war. And you had a United States that at the end of World War II could have claimed half the world as part of the United States. We did not do that. We actually built them up, right? Gave them loans to build up their own economy and pull their own people out of poverty and all this stuff. We didn't take over. So not only globalization, demographics, and technology, but also a global order of peace amongst great powers. And on top of that, you have access to a very elastic currency. So you had high returns on debt at the beginning, global peace amongst great powers, And that started driving globalization, technology, and demographics now, which that will just trail over. It's already tipping over. But yeah, it is not at all caused by the Fed. All right. He just did this whole spiel about how the Volcker myth and that they don't really do anything. Then he's like, oh, well, it's actually low interest rates caused by the Fed that has driven this. See the disconnect?
Had its policy goes backwards, which caused secular disinflation by producing a safe asset shortage, because that safe asset shortage produced a risky asset shortage, which means that there was an overall asset shortage, which meant that there was a money shortage. And it's this money shortage that then produced an incentive to find cheaper labor. And it's the money shortage that produced an incentive to, have fewer kids in the developed world. So on the technology point, it's easy to say that all the technology and digital revolutions that we've had over the last 40 years are what kind of produced that significant disinflation. But I'd actually argue that it was disinflation that produced a skew towards certain kinds of technologies that matched that disinflationary environment. Meaning that if there's a money shortage, let's create technologies that can deal with that money shortage effectively. And it's also incorrect to just say low rates are what facilitated those technological advances, because if we just look at real growth and productivity, the period from 1950 to 1985 actually had higher total real growth and productivity growth than from 1985 to 2020, which means
Yeah, that's a great point about how it's the form of money that drives the type of technology that gets invented. Um, there's a lot fewer 0 to 1s, right? There's a lot of 1 to manys. So technology, yes, I agree with him on that point. Technology is driven by the form of money mostly, but it doesn't have to be the Fed, right? You can replace the Fed, the place he's put the Fed in. All you have to do is understand diminishing marginal returns and then stretch that out to decades. Just like demographics is stretched out in decades, globalization is stretched out in decades, technology is stretched out in decades. You stretch out diminishing marginal returns. And think about this. So they ran out of returns in Japan. So what was next? They pivoted to China and they found a new source that stimulated returns that let this system continue a little longer for another couple decades. But now the China story is blowing up. So where are we going to get the returns? We're out of places. Who can take over for China? Africa? There is environmental geographic problems with Africa. It will not be the next great economic miracle. There is no other place like Japan or like China, especially when there's globalists involved and they're trying to destroy the world economy with all their environment standards and stuff like that. But very interesting. Let's keep going for just a few more seconds here.
That we were advancing faster as a country or civilization when rates were high than when rates were low. So just to put some numbers on it, from 1950 to 1985, real GDP increased 250% and productivity increased 115%. And then from 1985 to 2020, real GDP increased only 150% and productivity only increased 93%.
All right, so that's where I'm going to end it. I want to note that he didn't say the word elasticity, which I think is very important. That is why people actually adopted the credit-based system that we have today. And I'll add, if I go back to this slide here, this is a feedback loop. So lower growth leads to lower growth. Diminishing marginal returns leads to diminishing marginal returns in this system. So the great financial crisis was the end. Now we have to deal with it. How do we get out of this malaise, the silent depression that we've been in, and how do we get back to some sort of higher levels of growth? Because if we're sitting at 1-2% global growth, like there's going to be wars. Absolutely, there's going to be wars. The United States fabric is breaking apart. The European fabric is breaking apart. Look at China. That's one reason why I say China's probably going to have some sort of breakup or revolution. Because when you starve people of returns, you starve people of growth, then it becomes a zero-sum game. Then people start slitting people's throats. So there's a way out of this, though, and that is to reback the dollar, reback currency. If you reback your currency with Bitcoin, you can revaluate it. So instead of 40,000, you set it at 4 million, boom. And then a lot of that debt can go away. So that's where I think we're going here, and where the MMTers won't go. Their idea is to have way more government debt and raise the interest rates on government bonds. That's their solution to this. But anyway, the Fed does not exist. So, all right, guys, that's it. Thanks for joining me. Let's go back to bitcoinandmarkets.com if I can find that tab real quick. Bitcoin and market. Where the hell did you go? Right here. Okay. Bitcoinandmarkets.com. Check it out. Support the podcast. Actually, let me go and look at the comments since you guys have been waiting. If I can do that. Where is it? Here we go. Chat. No chat comments here. It is Friday at the end of business, so people are probably taking off. Let me check Telegram, see if you guys have made any comments. Rand, very interesting. All right. That's it, guys. Thanks for joining.